All right, guys. Well, to break down today's markets, joining us now, a good friend of the show, Thomas Hayes, chairman of Great Hill Capital. Tom, great to see you on the day. Help us break this down. What's been the biggest mover from your perspective?
Yeah, well, I think since the last time we were with you, Brad, and thanks for having me back, we've seen this constant push-pull day to day between cyclicals and value and tech and growth. It's kind of a battle royale. But the good news is we talked about it a few weeks ago, and it's actually worked. In the last few weeks, in the month of September, cyclicals have outperformed in industrials, materials, transports, and financials have all outperformed tech in the month of September. And that's pretty consistent with what we're seeing for 2021 earnings estimates for earnings growth. The sectors that are going to grow faster than the S&P are industrials at 87%, materials at 29%, transports that have outperformed financials at 30%, and consumer discretionary at 74.4%. And Brad, that's very consistent with the consumer confidence numbers that we saw this morning, which blew away expectations at 101.8. So that's very promising. And on the flip side, with the S&P growing at 26%, the technology sector is going to grow at only half that pace in 2021. They've pulled a lot of the earnings growth forward. They're going to grow only at 13.7%.
Okay, and so a lot of things to break down there. If I can go back to the consumer confidence front, though, what should we take away from that number going into a holiday season where it's going to be a story between the have-nots, or perhaps a tepid spending environment among some households where you are looking for more stimulus, you are looking for more answers on where you're going to find aid with whichever industry that you work within, especially as that may relate to some of the benefits that you are receiving, both employment benefits or unemployment benefits?
You bet. Well, surprisingly, this is a forward-looking number, and it is surprising to see the magnitude at which it beat expectations this morning. So the consumer is very confident. The consumer is slowly coming back. And I think I've mentioned with you in the past, I look a lot at China because they're about 2 to 3 months ahead of us in their recovery. And just like us, the consumer was the last indicator to really come back, and they just came back in the last month. So I could see by the holidays the consumer really taking off and being in good shape. But to your point, you hit the nail on the head. We do need some type of stimulus and or potentially, which we may see, a reallocation of the $380 billion left over from the CARES Act to help those most in need, whether it's a second stimulus check. The enhanced unemployment continuation is absolutely critical for those most in need. So we definitely want to see that to support those consumer confidence numbers that we saw this morning.
I want to kind of bring this conversation relevant to today. We're going into this evening's event, the first presidential debate between President Trump and former Vice President Joe Biden. And you did a really good job a few weeks back laying out exactly what the markets have shown in the past with regard to their reaction in any presidential candidate being elected, and what we should expect thereafter. What are the things that you watch going into an event like this tonight from both of the candidates, and what should we be keeping an eye on going into November 3rd?
Well, the number one thing that you don't want to see, Brad, is you don't want to see an electoral sweep by either party. In other words, you don't want a Republican president, Senate, and House, and you don't want a Democratic president, Senate, and House.
That's exactly what Goldman Sachs is calling for, though, isn't it?
Well, there are mixed polls all around, and it does look more likely since August that we are going to get gridlock. Whether you have a Republican president or a Democrat president, we're likely to have one of the houses in the opposite party. And over the last 100 years data, as you pointed out, Brad, that is when the market performs the best. And in this case, going into tonight's debate, as you pointed out, the core issue that the stock market is afraid of, leaving aside political ideology and social reform and different things people are interested in. But as far as the stock market, it's really worried about taxes. And the only way that would happen is if you had a complete sweep of the executive, Senate, and House to implement the Democratic tax plan, which would increase corporate taxes from 21 to 28%, and long-term capital gains for income earners over $1 million from 20% to 39.6%. So the market's a bit afraid of that, just because mathematically, if you take earnings from 170 down to 150, you're going to get a lower valuation in the stock market. But other people would say, well, that's okay. We'll make it up with fiscal spending over time. We'll make it up with other things in the intermediate to long term, and that may be a worthwhile short-term sacrifice for those people to make, and that makes perfect sense. But I think from a stock market standpoint, Brad, going into tonight, just no sweep, and the market will do fine regardless of who's elected for president.
And I should clarify what Goldman Sachs did say around this, to be fair. Goldman Sachs analysts saying that a victory for Biden plus Democratic Party controlling Senate and House of Representatives would be slightly beneficial to profits for the S&P 500 through 2024 was their marker there that
Correct.
They were looking at there. So just to clarify that.
Yeah, and I think that's a perfectly good point. In the short term, over time, like you said, to 2024, the impact of what they perceive to be increased fiscal spending would certainly be felt to offset that short-term drop. But the tax cut in the short term, we would feel it, and certainly people trying to lock in the lower tax rate on the long-term capital gains before year end, we would feel that. But again, that would only be affected if you had a sweep. And I think it's lower probability that you are going to get a sweep one way or another.
And so as we think forward to some of the other major issues that are still in the minds of investors, I continue to think about it, and I don't know if you and I have talked about this yet, on the U.S. and China front, specifically as it pertains to TikTok and what we've been watching from the administration labeling it a national security threat, all the way through to the phases of different deals that could come forth, to the narrowing down of the prospects of who would be involved within that deal and the players. It seems like Walmart and Oracle may get their way, but it comes down to whether the U.S. and China both approve. And so within that, you've also got this larger realm of U.S. and China that still lingers, where China could come back on this slippery slope that we found ourselves on and say that we've got an additional list of companies that now we're going to target and force some type of divestment in our region, which means a company that is in China would then have to invest in an American company trying to expand in that region. What do you make of all of that as it pertains to the broader negotiations that are still years ongoing at this point?
Yeah, well, 2 points, Brad, and your timing is perfect in that commentary, because they did come out with a list this weekend. It's something to the effect of the unsafe entity list, and it's expected that by the end of this year, they are going to name one U.S. company on that list, which could hinder trade. So that's kind of front and center, but what really matters is in the background. Are the conditions of the phase one trade deal being executed? And to their credit, their agricultural buys are actually on schedule for 2020. And that has to do in part, they had some flooding, they culled their herd, they lost about 1 million pigs due to swine flu in the last year. So they've been buying a tremendous amount of agriculture and pork from us in order to make up their shortfalls, but it's putting them over the hurdles for the phase one deal. So long as they hit those metrics, I think it's going to be largely rhetoric. If they start to fall back in their purchases, then I think potentially it could escalate over time, and that would be something to keep an eye on for sure.
And then just lastly here, of course, we have to talk about the economic scene with and without a vaccine. As we continue to monitor the 4 candidates right now that are in the most advanced stages here, at least in the U.S., and names companies that are based out of the U.S. As we continue to think about those companies and then the acceptance rate, we were mentioning this with Christina Hooper earlier in the show, the global chief market strategist over at Invesco, talking about what the variable is with a vaccine considered. And how do you look at that at Great Hill, specifically as it results in the economy reopening to the fullest capacity at the highest acceptance rate, perhaps, of the vaccine, of a successful and safe vaccine, I should say?
Yeah, I think there are 2 factors to this. The market is in this information vacuum, Brad. The vaccine earnings, the election and the stimulus package, which we've touched on all of them. But in addition to the vaccine, which we now have 4 in phase 3 trials, so we'll potentially get an announcement sooner than expected, which would be a nice surprise for everybody. We also have really good progress being made on the treatment front. So you've seen the death rate really go down as doctors learn more how to deal with it, with the steroids, with the remdesivir, and the monoclonal antibodies, which are now making serious progress. So I think it's going to come together as at one time where we're going to have the vaccine, we're going to have better treatments, and hopefully that's sooner than later. Because the earnings outlook, you've had 69% less companies issuing negative guidance for this quarter coming up in 2 weeks. That's much better than the average. So earnings numbers continue to go up. This economy really wants to explode. You've had 25% year-on-year money supply growth. That's going to lead to 6% growth in GDP next year. The election we talked about, we're going to find out a whole lot more in just a few hours. And then the stimulus, I think it's lower probability to get a package before the election, but it's higher probability that you could see a second executive order just to help out with the $380 billion, reallocate what was already allotted by Congress for the most needy. And I think that would be really, really helpful for those people who are in a tough spot right now because of COVID.
All right, Thomas Hayes, chairman of Great Hill Capital, joining us here today. Thank you so much for the time, as always, Thomas. We appreciate it.